It's 2019. The UK has left the European Union without a trade deal. Unemployment has doubled. Houses have lost a third of their value. Meanwhile, the global economy is slowing down and US stock markets have fallen by 50%. Would the UK's banks survive this nightmare scenario? That is the question the Bank of England has posed in its latest test of the country's financial sector, and the answers are encouraging. The UK Central Bank says all 7 major commercial lenders have enough capital to meet its standards. It's the first time all the big banks have passed the annual stress tests. Now, the Bank of England believes that lenders could absorb losses of up to $67 billion over the next few years and keep on lending to support the economy. That is greater than the losses they suffered during the 2008 crisis. But it's also forcing commercial banks to hold an extra $8 billion in capital to protect them against risks beyond Brexit. For example, it wants to make sure that banks can withstand events such as a jump in global debt levels and penalties for misconduct. But there are still areas of concern. 2 banks in particular, Barclays and the Royal Bank of Scotland, emerged as the weakest lenders, even though they did pass. And the central bank is worried that Brexit could leave 6 million insurance policyholders in the UK and 30 million in Europe with worthless contracts. And the insurance contracts that banks trade with one another could also be in doubt after Brexit. The total value of those derivatives stands at nearly $35 trillion. That is about 13 times the size of the British economy. Let's get more on this now with David Madden. He's an analyst at CMC Markets in London. Great to have you with us, as always, David. Let's talk about the criteria that the Bank of England used for their stress tests. Are you convinced that these criteria are tough enough for the conditions we see in the economy? Could a post-Brexit downturn be even worse than the scenario painted by the Bank of England?
Of course, everything is a possibility, but these are pretty dire circumstances. For example, the property prices in the United Kingdom would have to fall by 1/3. We would have to see a major spike in unemployment, an explosion in debt, and not to mention quite a free fall in global asset values. So should we enter that scenario, it certainly is a possibility, but I would like to think that the economists and the risk managers at the Bank of England were pricing in a very, very, very low probability of that event actually happening.
David, so Governor Carney raised the need for legislation to ensure that cross-border insurance policies are honoured. What happens if there is no such agreement by the time there's Brexit? And they fail to negotiate a transition period? What are the consequences of that?
Well, the consequences are that you would have, well, millions of people across the continent of Europe, and also millions of policyholders here in the United Kingdom holding policies which are actually no longer valid. And what you could see is, well, a combination of a scramble to get new policies to ensure that they are insured, but we can also see customers taking claims against those insurance companies for saying, you took my premium, now you're not actually insuring me. Like how we saw mis-selling of PPI at some of the major British retail banks, we could have a similar scenario whereby policyholders who were told they were insured and then to find out they were no longer insured may look to actually seek compensation.
And there are potential problems with the credit default swap market as well. As we mentioned, this is the insurance against possible defaults, and that is that multi-trillion-dollar market. What are the consequences for that industry, for that market in particular?
Similar as well, the CDS market, the credit default swap market, was obviously much more prevalent a number of years ago when the Eurozone debt crisis was raging on. But if we get to a scenario whereby, similar, as I just mentioned, with insurance, if you hold an insurance policy, which can be quite pricey, only to find out that the writer of that insurance policy isn't willing to actually back up their end of the bargain, we could obviously have an illegal entanglement whereby one party paid to be covered while the writer writer of the policy refuses to actually extend the cover, we could have a scenario whereby the policy holders seek compensation, and in turn we could see an entire string and a run of legal battles and potential compensations have to be set aside by the writers of those particular contracts.
A messy scenario. Now, look, many banks in the city have put in place contingency plans for Brexit. As we approach the end of this year, how likely is it that they may start actually implementing these plans to move large numbers of people off to the continent?
I don't think it's as likely as some politicians or as some political pundits would have you believe. A lot of these major organisations already have operations, be it in Dublin or be it in Frankfurt or Paris or Amsterdam. The movement of people and the movement of capital, well, the capital is and the infrastructure that goes with the building obviously takes a bit of time, and obviously it can be quite costly, and the moving of people can take some time and can also be quite costly. So I suspect the banking industry is going to continue to lobby the EU and certain pro-Remain politicians here in the UK to try and get the United Kingdom to remain in the common market, in the single market, in the customs union, as a way of actually kind of softening the deal on their side. I think they're not going to be as quick to move to the continent as some of the bankers are letting on.
Right, and while we're on the subject of Brexit, David, there's brewing row over this potential economic impact report that we're expected to see from the government. How are investors bracing themselves for what might be in this report?
Well, to be honest, these sort of reports make much more political news than they do financial news. If you take a look at how Eurozone stock markets have performed, American stock markets have performed, and indeed the British stock market, the FTSE 100, isn't too far away from an all-time high. So, if anything, if it's an absolute doomsday scenario, we could see a bit of a correction and hand back some of the gains that the FTSE 100 has made in recent months. But by and large, the FTSE 100 is doing quite well. Bearing in mind, the FTSE 100 is quite an international index, so any doom and gloom reports for the UK could send sterling tumbling and in turn make the FTSE 100 and some of its components cheaper to purchase.
Interesting times. David Madden, CMC Markets in London. Thank you so much.